Trade like a casino. The secret to profit. Even when you're wrong, the cursor hovers over the entry button while the candles stutter on the 1-minute chart. The setup is clean. A pullback into a rising 20 MA, VWAP under price, buyer imbalances showing up on order flow, and a higher low wedged against yesterday's high. Your stop loss is obvious. 3 ticks below the swing low. The risk-EYOX reward makes sense on paper. Yet your fingertip floats and freezes because the last trade looked exactly like this and reversed in 2 seconds. The platform pings. Margin available is fine. Slippage last fill was 1 tick. Your chest tightens anyway. You blink, hesitate a heartbeat too long, watch the green candlestick elongate without you, then slam a market order at the top of the burst. Now you're in. Late spread widened, P&L flickering. Level 2 rattling like a jar of coins. You hover the mouse over the stop and nudge it down a notch just to give it room. The next candle wicks, taps your new line and flushes. Red. You feel it in your gut like cold metal. The cursor drifts back to buy. Get it back, a voice says. The chart says wait. Your brain says now. You click and the house smiles. Here's the uncomfortable truth of trading like a casino. The house does not win because it guesses right on the next spin. The house wins because it sizes properly, enforces rules mechanically, manages variance across thousands of independent trials, and never ever moves its stop. In a casino, the edge is microscopic but relentless. In trading, your edge is your process position sizing, entries and exits, and the discipline to let the math work over a sequence, not a single trade. Most traders lose money not because they can't read a chart, but because they can't make themselves act like the house when their screen is screaming at them. They think in predictions, not probabilities, in single outcomes, not sequences. The market gives you a setup. Your job is not to be right. Your job is to extract the house edge from that setup with position sizing and stop placement that assume you might be wrong and still profit over time. Your brain is not built for this. Dopamine surges when P&L turns green, which trains you to chase the next candle, even as your plan says, not yet. Cortisol spikes when your position prints red, which trains you to cut winners early and hold losers just a little longer. Adrenaline floods during volatility, narrowing attention to the last tick on level 2 instead of the higher time frame structure on TradingView. A string of losses depletes serotonin, and your mood colours your chart reading. Suddenly every wick looks like a trap. Mirror neurons fire when the chat room erupts and you mimic entries you didn't plan, because social proof feels like safety. Meanwhile, the platform itself is designed to amplify this neurochemical carnival, flashing green-red P&L, audible fills, real-time heartbeat of the tape. You are wired for survival, not statistics. Casinos designed for variance. Most traders designed for comfort. That's why entry hesitation paralysis is so expensive. The setup appears, the rules are clear, but your memory replays the last whipsaw. You freeze miss optimal entry, and the only way to reclaim control is to buy high, sell low, or size up to catch up. Exit greed extension is the twin refusing to take your planned exit because the last winner ran without you. Both are fear reactions to variance dressed up as analysis. Then comes stop-loss removal syndrome. You place a stop where your system says price is wrong, watch price approach, and nudge the stop to avoid a wick. What you avoid is accountability. And if that fails, revenge trading loops complete the cycle. Double size to erase the red, then triple the shame. Overtrading compulsion, that's your dopamine system begging for another spin of the wheel. Chart pattern hallucination, that's your pattern-seeking brain stitching meaning into random clusters of candlesticks, because uncertainty is intolerable. Here's the paradox the market loves to weaponize. Perfect setups fail most often because perfect is crowded liquidity collects where your stop sits. The best trades feel uncomfortable because they trigger fear cues that coincide with value. More analysis can deliver worse results by feeding the illusion of control and delaying execution. Tighter stops create bigger losses by forcing repeated re-entries and slippage churn. More screens can mean less clarity. 6 monitors of RSI divergence, moving averages, and volume profile can bury the only question that matters. What is my risk and where am I wrong? The house edge lives on the other side of these paradoxes. The casino takes bets from tourists hungry for certainty and offers them probabilities. The trader must do the same, to themselves first. Watch the cost of ignoring this. Averaging down disasters don't begin as disasters. They begin as an identity conflict. I am a good trader, therefore this trade will work. The first small red becomes a bigger red with a second ad, at value, then a third, at support. And soon your margin warning flashes, while the volume profile shows price exploring a new distribution. A FOMO market order during a breakout looks logical because candlesticks are stretching, and level 2 shows offers getting lifted. But if your plan was an early pullback entry near a VW app, the breakout is an expensive lottery ticket disguised as momentum. Moving stop losses always feels sensible. The spread widened. Give it a few ticks. But your risk-reward collapses silently, and your expected value turns negative. Weekend holding anxiety? That's your brain screaming for closure against gap risk, not a signal from the chart. News trading paralysis? You're trying to convert macro uncertainty into a 15-second decision, while algos digest the release in 15 milliseconds. Past patterns don't guarantee the future, and the single most reliable statistic in trading is still brutal. A majority of traders do lose money. Risk management is survival, not a slogan. This is not financial advice, it's a mirror. Now meet Marcus, the risk manager. He's built like a casino floor, not a crystal ball. His desk is sparse, 3 monitors, not 9. TradingView runs left with daily and 4-hour timeframes to define structure, support, choppy and resistance, moving average slopes, and RSI divergence to flag exhaustion zones. Center screen shows his execution chart. 5-minute for context, 1 minute for entries, volume profile for imbalance, VWAP and 2050 EMAs for trend posture. On the right, level 2, an order flow, just enough to sense when bids are absorbing or offers are slipping. He keeps a small window with realized and unrealized P&L, but he can keyboard hide it when he feels tilt. The routine begins before dawn. He journals a pre-market narrative. What's the bias by time frame? Where is price wrong? Which setups are allowed? How many trades per session? Maximum total risk, maximum drawdown, and a daily stop. His entry criteria are mechanical. For trend trades, he needs a pullback into the 20 EMA with VWAP support and a buyer imbalance on tape. For mean reversion, he needs 3 pushes into a level, trapped breakout order flow, and a 1-minute failed continuation candle. No setup, no trade. He sizes positions by a fixed fraction of account risk, not by confidence. 1 hour per trade. If the stop is 0.35% away, the position size is calculated to risk exactly 1 hour, not about that. Marcus treats every trade like a blackjack hand with a known expected value. He knows the win rate of each setup from his journal. Trend pullbacks win 46% but yield 2.2 R on winners. Failed breakouts win 41% but yield 2.6 R. He knows his average slippage. He knows his actual risk of ruin if he strings together 10 losers. He never adds to a losing position unless it's an explicitly predefined scale plan with a higher expected value, not a hope. When the platform freezes during volatility, because that too happens, he has an OCO stop touch a target server side. If the internet dies, his rules do not. When he gets clipped 3 times in chop, he stops for the session. Not because he's scared, but because variance clusters, and the house doesn't tilt into a cold deck. Marcus still feels things. When he gets a green streak, dopamine tempts him to increase size. He doesn't. He increases his distance from the screen 2 minutes of breathwork, shoulders back, eyes soft. When he gets clipped at the low tick before a push, cortisol flares and whispers, "Move the next stop wider." He doesn't. He writes, "Slippage is a tax, not a verdict," in the margin of his journal, and takes the next valid entry with the same 1 hour risk. He has a hard rule. If he catches himself moving a stop even once, he reduces size by half for the next 3 trades to disrupt the habit loop. He uses the platform to protect him from himself. Bracket orders with fixed stops and targets populate as soon as he clicks. 1 tweak allowed, trail only if a clear structural break occurs on the execution timeframe. Higher low after a measured move, or a reclaim of VWAP after extension. He runs a pre-mortem before the open. How specifically will I lose money today? He writes, overtrading chop, chasing breakouts, holding losers, increasing size because of emotion, ignoring the daily stop. He writes the antidote next to each, 3 trade limit per hour, only breakouts with 30-minute expansion and cumulative delta confirmation. Stop loss must be obeyed because moving it breaks the edge. Size can only increase after 20 trades with expectancy. 0.7 R. hit daily stop, close platform. He rehearses the worst, 5 losers in a row. He sees the sequence, feels the heat, breathes it down, and visualizes doing nothing heroic. Casinos don't chase. They widen time and let the math catch up. His rewiring process is built on 5 pillars. First, a pre-market routine that primes probability thinking. He reads his own distilled rules every day, out loud, like a pilot checklist. I do not predict, I execute. I accept random distribution of wins and losses. My stop is truth, not a suggestion. 1 setup, 1 risk unit, 1 exit plan. Second, position sizing rules that remove opinion from exposure. 1R risk per trade, 3R daily stop, 6R weekly stop. If he hits 3R down on the day, he stops. If he caps 6R on the week, he trades sim on Friday. Third, a journaling template that captures the only numbers that matter. Setup type, entry, jock, exit, stop distance, R booked, mistake or not, emotional state, adherence to plan. He tags each trade as A, clean, B, minor deviation, or C, rule break. Only A trades count for performance review. Fourth, an alert system to fight overtrading, alarms at key levels on higher timeframes. If no alarm, he doesn't stare at the tape. Let the market come to him. Fifth, cooling off periods. 3 consecutive C trades trigger a mandatory 24-hour break. 2 losing days in a row trigger a micro vacation walk outside. No charts until the evening review. Marcus borrows the casino's secret weapon. He defines the game. He only plays his game. Nothing else exists. That means he refuses to engage with markets that don't match his edge. Sideways lunchtime ranges. He's flat. News minutes. Flat unless his plan includes a specific post-event setup with reduced size. Thin overnight sessions. He sizes down or doesn't play. He treats every time frame like a table in a casino. Some are hot for his edge. Most are not. He doesn't need action. He needs sequences of clean trials. The paradox becomes his ally. The best trades feel uncomfortable, so he trains to lean into the discomfort that accompanies entries at value. The more he wants to interfere, the more he commits to doing less. When he feels the itch to move a stop wider, he instead closes the DOM and stares only at structure. He is ruthless about uncertainty. His job is not to reduce it, it is to price it with his stop. When Marcus explains trade like a casino, he doesn't mean be cold. He means be consistent. A casino with a 2% edge that takes 1 bet a day goes bankrupt on variance. The same casino taking 10,000 bets a day mints money from the law of large numbers. Marcus scales his trial count through time, not trade frequency. He protects his capital by capping daily risk and protecting his psychology by scheduling breaks. He designs his environment to make discipline easier than impulse. He hides P&L during trades. He keeps his journal open on a side monitor with his if-then scripts in bold. If price breaks and closes above the level on expanding volume, then I enter on first pullback with 1R risk. If I feel anger after a stop, then I stand up and breathe before touching the mouse. If chat pumps a ticker, then I mute it for an hour. He builds friction into bad behaviours and lubrication into good ones. You can build this too. Start with your pre-market routine. On TradingView, mark daily and 4-hour levels. Prior day high-low, weekly open, obvious supply-demand zones, VVWAP bands. Define bias by time frame. At 1.9 by. Bullish above yesterday's high with acceptance. Neutral inside. Bearish below yesterday's low with momentum. Write your allowed setups and the exact entry trigger. A candle pattern, a reclaim, a failed continuation, a measured move completion. So you're not feeling value, you're observing structure. Set alerts at levels so you aren't glued to every tick. Decide your maximum number of trades. Decide your daily stop in ARM. Decide when you will walk away. Casinos pre-decide everything, then fix position sizing. Choose a constant risk per trade relative to account size. So your 1R is the same dollar risk whether your stop is 5 ticks or 15. Automate the math. Create hotkeys or order presets that place a bracket with your stop loss and take profit instantly. OCO linked so your hand cannot forget. Backtest your setups on screenshots, not fantasies. Count sequences. Ask, what is my real win rate? What is my average R when I win? What is slippage doing to me? How do I perform in high volatility versus mid versus low? Casinos know their tables by hour. Tackle journaling like a performance coach. For each trade, paste a screenshot with entry, stop, and exit marked. Write one sentence on context, one on your trigger, one on execution quality, and one on emotion. Tag mistakes unflinchingly, entering outside the rules, moving stops, adding to losers, closing winners early, trading in no trade zones. At the end of the week, compute expectancy by setup. Win rate X average win R, loss rate X 1R. Kill, improve, or keep. Casinos close losing games. You should too, and wire in the neuroscience. Place physical cues where you sit. A sticky note. Breathe 4-7-8 before entry. A wristband you snap to interrupt spirals. A kitchen timer for 5-minute resets. Train your body to recognize adrenaline and respond with a ritual. If your heart rate rises before clicking, you're not weak, you're human. Pair that sensation with a slow exhale and a count of your stop distance out loud. Hear yourself say, 1 risk unit. You're teaching your amygdala that the stop is safety, not threat. Build routines to raise serotonin between sessions, sunlight, movement, hydration. It sounds soft until you notice how much clearer the chart looks after a walk. Expect paradox. When the setup is clean, expect it to fail enough that it doesn't rattle you. When it feels ugly, expect it to be value enough that you take it anyway, small size, clean stop. Expect analysis to tempt you to defer action. Build do less buttons, hide indicators, shrink screens, reduce inputs until only structure and risk remain. Expect tight stops to seduce you into precision you don't possess. Place stops where you are wrong, not where you feel brave. Expect more monitors to feed more impulses. Try 1 screen days. Discover you didn't miss anything but noise. Now picture the transformation. The platform is the same. The market is not kinder. Volatility still surges. Spreads still jump. News still blindsides. But you are different. You sit down and your hands find the same keys. You run the same checklist. You wait for the alert at your level instead of hunting. The first trade of the day triggers. You place it without commentary. Your stop lands where price says you are wrong, not where your ego says you must be right. The candle wicks you out by a tick. You feel the heat in your jaw, then the breath in your belly. Your hand does not reach for the mouse. You log a trade, 1R, clean. You stand for 60 seconds. The next alert fires, the same setup. The same risk, you take it. It runs to target in 20 minutes. You don't move the profit target because you feel it could go more. You exit at plan because casinos pay on rules, not vibes. Your P&L is irrelevant to your identity. It's a scoreboard of sequences, not your worth or intelligence. By the time the session ends, you've taken 4 trades, 2 wins, 2 losses, plus 1.4 are net. It's not dramatic. It's not Instagram. It's a quiet machine humming. Over weeks, your journal shows fewer C trades and more A trades. Your equity curve still breathes it, always will. But a strange calm settles in. You stop narrating the market to prove you're smart. You stop inventing patterns to soothe uncertainty. You stop moving stops because you'd rather be honestly wrong than endlessly trapped. You become the house in your own mind, the one setting the rules and managing variance. Most traders lose money. Past patterns don't guarantee future outcomes. This is not financial advice. Risk management is survival. But survival, repeated enough, is where consistency hides. Trade like a casino. Small edge, enforced ruthlessly, over a large sample with risk per position defined before the entry and never debated after. When you're wrong, and you will be wrong often, you will still profit over time because you will be playing a different game than the tourists spinning candles for entertainment. And in that game, the only secret is the one casinos have used forever. Edge plus discipline beats prediction plus ego. Always.